Good evening everybody, thank you very much for joining in, and this side Rahul Magan here. I am speaking on behalf of Hedge Consulting LLP as a Chief Executive Officer. It's a limited liability partnership firm which is having multiple revenue stream, and we are very pleased to share that we have more than 5 international collaboration on the way, and we are moving towards 6, but this time the 6th is in India. We recently did in collaboration with Interfima, which is an International Institute of Financial Management, which is a Luxembourg-based firm, and we are here taking over as a trainings and a consulting business with Interfima and we jointly, right? And today, in the very earlier video, we talked about the issues with the Masala bond, and now I am going to explain you how to hedge Masala bond, right? Because we stated that the Masala bond was 8.33%, 6.5% was the cost, so total net was he was making 1.8%. But now we are going to tell you how you are going to hedge Masala bond. I know this is little tricky. Please pay attention, and it may possible that you are not aware about the few words, but something which you need to pay attention very deeply, and if you understood this, then it make a lot of sense for you how to hedge the Masala bond. Here we are taking a simple example. We have HDFC Bank who issued 3000 crore bonds at 8.33%. That is a fact, with a minimum maturity of 3 years, maximum maturity of 5 years. Suppose you have an offshore investor whose name is Goldman Sachs, who invested in this 3000 crore 8.33 bonds. Now there is a doubt. The doubt is that here we are taking an example that Goldman Sachs, Goldman Sachs has not first converted their dollars, rather than they already have some INR in place and which they directly invested, right? Now they are receiving INR, they not converted their dollars into INR, right? Now what they basically they are having some INR which they invested with the HDFC Bank, and for which they are getting 8.33%. So they not converted their dollar first and then get the INR. Let me explain simply. HDFC Bank issued 3000 crores. Goldman Sachs already have an INR. They given this INR to HDFC, for that HDFC is giving 8.33%. Very simple. HDFC Bank is giving 8.33%. Now how Goldman Sachs will hedge their risk in that? Now what Goldman Sachs would have? Goldman Sachs is getting 8.33% of interest from the HDFC Bank, but they need to hedge the currency risk in the system. Yes or no? They need to hedge the currency risk in the system, else they are gone. But the point here is they cannot hedge the currency risk in onshore. What do you mean by onshore? They cannot hedge with in India. But here we have simplistically taken an example that they are hedging with HDFC Bank Singapore. What they are going to do, this is a non-deliverable forward contract. At the end, HDFC Bank will deliver the offshore, will deliver the INR to this offshore party, right? Because they had given that, and the bond will mature. Because they have invested, say 100 crores out of this 300 crore. So what Goldman Sachs will do, Goldman Sachs will go to HDFC Singapore because it's an offshore location. One point which we should not forget, that the 1 year non-deliverable USD INR forward contract is trading at 6.5%, which we mentioned here. So 6.5% is the cost. Another thing we should not mention, that considering the fact that Indian rupee is exorbitantly depreciating in nature, there is a big probability that INR will go to 70, and especially when Mr. Raghuram Rajan would basically move forward to his next position somewhere in September 2016, rupee would surely depreciate, because the 3 legs, inflation targeting, fiscal targeting, and liquidity, this is, I don't think the next governor is able to maintain, with due respect, what Raghuram Rajan did. Although I do have certain differences when it comes to the computation of the inflation by Reserve Bank of India with Raghuram Rajan. But nonetheless, so you will go to HDFC Singapore and you will say, I wanted to hedge this. HDFC Singapore say, let's do POS. Now what is POS? Principal only swap. Let's do principal only swap. In this, what you are going to do, neither you will deliver me INR, which is this, neither I am going to give you any this, which is this, because this is not onshore. You will do a non-deliverable forward contract with me, and what you will do, you will buy dollars from me. You will buy dollars from me because you will convert your INR into dollars back. You will buy dollars from me at the rate of 6.5% NDF. As we clearly understand very well, non-deliverable forward would have 5 components, although this channel have number of times explained this to you. Number 1, the bank who is taking a position should not be Indian bank. We have taken an example of HDFC Singapore. The party who is taking the position should not be Indian party. We have taken Goldman Sachs. They will not deliver INR. They will not deliver any dollar. The net settlement would happen in dollar terms. It could happen in GBP also, Euro also, Swiss franc also. So that cost you need to consider. Now what do? You hedge today. So today is 6th of August 2016. You hedged for 6th of August 2017. On 6th of August 2017, since you bought dollars, remember the fact you bought dollars. Suppose INR depreciated. INR depreciated to 72, 73, 74. And you bought dollars at say the 1 year is trading at 67, spot 5 rupees the premium, 72. Suppose INR will go to 73 after 1 year, you would have a gain of 1 rupee, and suppose INR would appreciate to 70, you would have a gain of, you would have a loss of 2 rupees. Now there is an issue. The issue is that the 1 year volatility of the INR is close to 10%. Who knows where INR will swing? Here or there? Nobody knows where INR will swing. And if you don't know where INR will swing, then how I can take this position? I have not included gain and loss in this example. I have simply said that I invested at 8.33%. The 1 year cost was 6.5%. If I difference this, I would get 1.8%. But this is not right. This is not right. Because who will take the final net settlement gain and loss into consideration? Suppose INR will end up 73, you would have a gain of 1 rupee, and INR will end up at 72, say 70, you would have a loss of 2 rupees. Then you are gone. You are simply gone. Henceforth, the hedging of the Masala bond is very, very complicated. So you have two positions in Masala. Number 1, you go to your offshore and you directly buy the NDF forward contract. Secondly, we will explain you via carry trade route. You can take a carry trade route, but this is our next video which would be coming tomorrow. That you can come to India and do a carry trade position using a Masala bond, but this is little technical in nature. But before winding up the video, I would like to summarize one fact here. Don't try and ignore the gain loss from your positions. You don't know where you end up. You will end up having some gain, you end up having some loss. You don't know that. Nobody knows that. I myself acting as a corporate treasurer for an American company, when we used to take non-deliverable forward contract, we ourselves do not know where we end up. In that sense, you left up with one option, which is non-deliverable options. So the upcoming videos, two videos would be how to hedge Masala bond using non-deliverable option, and second, how to hedge Masala bond using a carry trade. But before winding up, let me summarize. Number 1, you are a bank, HDFC is a bank who issued 3,000 crore bonds at 8.33%. Also, offshore investor is a Goldman Sachs. We should not forget that the hedging of a bond in offshore, in like Singapore, which is the global treasury center, offshore treasury center, is approximately 6.5%. We again should not forget that in HDFC, in non-deliverable, the party who is taking a back position, which is bank, should not be Indian party, HDFC Singapore. This party who is on the counter side should not be Indian party. This is Goldman Sachs. We will not deliver anything, neither we will receive anything. Net would be the gain loss, net settlement. So this is how we will take the position of the Masala bond using non-deliverable forward contract. The next videos would be how to hedge using non-deliverable option and non-deliverable, and we will try and cover non-deliverable swaps as well. and one video would be video would be how to hedge as a carry trade. Our contacts are treasuryconsultingllp@gmail.com. Our alternate email ID is rahulmagan8@gmail.com. Our mobile number is 9899242978 and my Skype ID is rahul5327. Thank you and have a great day.